Hello and welcome to our latest instalment on our deep dive on all things resilience. My name is Ciaran Flynn and I'm Head of Governance and Consulting Services here at Arthur Cox. Today I'm delighted to be joined by my colleague, partner Sarah Thompson from our Financial Regulation Group. We're here to talk about financial resilience. So turning to you, Sarah, we have seen increased focus from the central bank and indeed from the European regulators on stress testing, liquidity buffers, and capital planning for resilience.
Yeah.
How is this impacting Irish market participants?
Yeah, Karen, thank you so much. You're absolutely right. I think we are seeing this impact market behaviours in the Irish market. And I think it's helpful just to pause briefly on the points you've just mentioned that we're seeing from the ECB and from the CBI, because I think we are seeing more granular, more frequent reporting and hand in hand with heightened regulatory scrutiny. So not only are firms and institutions submitting their reporting, you also have regulators that are poring over it in greater detail. And then tied to that, you have increased capital reserving around, especially around liquidity buffers. So things like high quality liquid assets, the liquidity coverage ratio, and net stable funding ratio thresholds. And I think that has been particularly challenging for smaller institutions, not just in Ireland, but Europe wide. And holding excess liquidity, if we can put it that way, can compress margins and just make innovation in your business that bit more difficult. And then again, as you say, this challenge around balance sheet monitoring and ensuring that you have appropriate capital adequacy planning. Regulators are demanding more and more forward looking plans that incorporate stress scenarios over multi year horizons. So, with those three things in mind that you were picking up on, I think we're seeing a few things in the Irish market. So, we're seeing a reduced risk appetite. So, firms are tightening their credit standards and they're perhaps slowing some of their growth strategies in order to preserve capital. And I think as well, again, I was talking about smaller firms earlier, they are facing a proportionately higher compliance cost, not just in the figures of the liquidity margins that they're required to set aside, but also in their compliance costs. So, in their calculations, in their accountants. So, it's not just that final bit that you're setting aside, it's also the work you have to do to calculate that and decide what you're going to set aside. And then finally, anecdotally, you might see some liquidity hoarding. So banks and financial institutions and investment firms holding on to more cash. And I think that then tightens some of the liquidity that's available in the Irish market more generally for the real economy. So I do think we are seeing those impacts having a real world impact in the Irish market.
Thanks, Sarah. That gives us a great overall picture. I suppose thinking about the capital requirements rules, be they coming out of CRD4 or Solvency
Yeah.
2 or IFR, ultimately they're designed to make sure that firms have an adequate capital buffer
Mm.
when things goes wrong from a liquidity
Yes.
perspective. So, can you tell me more about how and when firms can access that buffer and what management should be doing if they find themselves in that unfortunate situation?
As you say, they're there for those stress scenarios. So it's one of those things where firms hope they're never going to need to use these things. But in that, I think there's three main points to bear in mind. I think detection, communication, and remembering to think locally. So if we go to detection, first of all, I think it's really important that firms have robust risk management systems in place and also risk appetite monitoring so that they identify early bumps in the road for liquidity and capital adequacy. The earlier you identify that, the more time you give your firm to course correct. So that's detection. Communication is also key, and that's communication on multiple levels. So it's communications within the firm. So if you have, your financial officer and your finance team and your accounting team looking at that, that should be there should be a virtuous feedback loop going to executives, going to the board to make sure that everyone is aware of the firm's liquidity situation at any given time, but especially in times of stress. And so that's communication within the firm For a number of firms in the Irish market who are operating in a global context, it's also making sure you're communicating with your sort of brother and sister institutions across the Atlantic or in Europe to make sure that any group requirements are being picked up, and so that group is aware early of anything that's going on in the local entity. And thirdly, your regulator. So making sure that you are communicating with your regulator promptly, especially if we have had that early detection coming to fruition, it's making sure you're not slow about updating the regulator. And as well, again, talking about those firms who are operating in a global context, perhaps as part of a larger global group, it's really for the managers of the Irish firm to remember the specific needs of the Irish firm, especially in a world where you're thinking about the individual accountability framework. I think it's well understood by the market and by the regulator that we don't operate in isolation, and that a number of Irish firms don't operate in isolation, but is really remembering that the firm has to sit within that global context and that you have responsibilities to your Irish regulator, if you like. And so, in a way, capital buffers are there to be used. You hope never to have to use them. But if you are going to be looking to use them, I think the absolute mission critical thing is to be communicating early and clearly with your regulator.
Thanks, Sarah. It's interesting that you frame this in the context of risk management
Yep.
more broadly and risk appetite. And it reminds me of what the CBI published in December in terms of their thematic assessment of operational resilience for MiFID firms. And really, one of the themes that came strongly out of that was that lack of integration between resilience planning and broader risk management. So I think that's probably something that firms in the market probably need to
Yeah.
work on more broadly. Stepping back and given recent examples, whether that be the ongoing sanctions with the Russian regime or everything else that's happening in the world at
Yeah.
the moment, which can cause challenges, there is a potential for reduced liquidity of certain assets and portfolios. Given that context, how can firms protect themselves to make sure that they can meet their financial obligations as they fall due, but also not fall foul of their regulatory requirements?
And I think you're absolutely right to highlight the current geopolitical situation. I think a number of these rules, or at least the current iteration of these rules, have their origin story in the financial crisis, which was a very particular sort of stress that really did bring into sharp focus the capital and liquidity of financial institutions in particular. In the current scenario, I think we're more focused on sort of those geopolitical questions, but they are no less impactful on financial institutions. And so, for firms looking for tools to manage their capital and liquidity in this world that we're living in, I think there's a few things you can do. So perhaps continuing to focus, and in some cases bring more focus onto liquidity management. So more frequent monitoring, more frequent reporting to the executive. So it very much becomes a business as usual topic of conversation. It's not something that comes up less regularly, it's coming up more regularly. And then I think applying, I suppose, plausible but potentially extreme stress scenarios, and then applying lessons learned. And I think a key place that can be done is in the ICAAP process. And indeed, I think that's something that's mandated in your ICAAP process to look at stress testing scenarios. But I think that is your opportunity in your regular work in this area to bring a little bit more of the geopolitical situation to bear in your planning. I think as well, looking at diversification of both exposures and liquidity sources. So I think it's perhaps just giving some thought to, are there other opportunities here to do more from different sources? And as I say, that's on both sides. It's also on your exposure side and on your liquidity side. And for investment firms too, I think there's an opportunity to look at redemption gates. So in the situation we find ourselves, I don't think investors would be surprised if investment firms were looking at their redemption gates and looking to make tweaks to that. So that might present an opportunity for managing your liquidity in the investment firm scenario. I think as well, looking at all of those tools is making sure your communication strategy is fit for purpose. So it's perhaps looking internally. Is there a good flow of information from your finance team to your executives, to your senior management team, to your board, looking at your group communication strategy. So if you're operating in that group context, is there a good flow of information from the Irish entity to the mothership, and making sure that that communication is there, but also critically to your regulator. So we talked right at the top of the session about increased regulatory scrutiny, enhanced reporting, more granular reporting. That's the regulator being interested in this. So I think communicating with your regulator through that reporting, and I suppose entering into it in a spirit where it is a dialogue, can be helpful. So I think those are the key things to bear in mind.
Great. And thinking about the ICAAP, I suppose, given the amount of effort that goes into the ICAAP and indeed the ILAAP for those entities that have to prepare one, how can those documents be levered in the event of a financial resilience event?
And I think the ICAAP and the ILAAP make you think about these extreme but plausible scenarios. So it's an opportunity to deal with sort of the real world risks that we're already thinking about. But I think there has been a tendency in some firms to think of it as a one and done type exercise. So it's something we do on a periodic basis. It goes on the shelf and we forget about it until the next time it's due. So I think we are seeing firms increasingly thinking about it more dynamically and more as a tool that can be used to bring feedback to your planning. So it's those extreme but plausible scenarios. It's looking at your business as usual risk management framework and seeing if any of those stress tests are revealing tweaks that should be done in that business as usual environment, as well as in your recovery and resolution planning. So the two should be integrated. So you shouldn't sort of be thinking about your business as usual risk management framework on the one hand and your recovery and resolution plan on the other. The two should sit nicely together, so that we have an integrated approach to that financial resilience. And I think also the ICAAP and the ILAAP process, back to communication again, it's a great opportunity to bring internal stakeholders up to date on what the firm is doing, what the firm is planning, and what tools the firm has at its disposal if things should get difficult. And running those stress tests frequently helps different areas of the business prepare for what may happen in a stress scenario. And what that does, I think, if the stress scenario does come into being in a real world scenario, it means folks across the firm have a level of confidence that they know what tools are available, they know how those tools work, and they have some idea of how to deploy them. It can never be perfect. An exercise is always an exercise. But having gone through that exercise, when you're met with that real world scenario, you have that little bit more confidence going into that real world scenario that we've done this before. I know how this works. So I think that can really be brought to bear in your planning for your financial resilience.
As ever, it seems to be all about communication
Yes.
and forward planning.
Yeah, absolutely.
Very good. I suppose, in conclusion, financial resilience and that downside risk may not be something that people want to think about, but it's clear that this is a key part of the broader resilience posture and something that's not going away.
Absolutely.
Yeah.
Thanks, Ciaran.
For more on all things resilience, please visit orthocox.com/resilience. Thank you very much.